everyone, and welcome to our first explanation in Managerial Accounting, Accounting 160. And we're going to be talking about what is presented in Chapter 1 of our textbook. You may have already read that. You may watch this prior to reading, whatever is best for you. So we're going to jump in and talk about managerial accounting and really, why do we care? We're going to get some terminology. We're going to understand how it relates to the financial statements. Most of you have already had or are currently taking Accounting 150, which is the financial accounting. So you've been introduced to the idea of the income statement and balance sheet. Income statement has revenues and expenses. Balance sheet has assets, liabilities, and equity. So that Accounting 150, you learned about financial accounting. This is managerial accounting with a different focus. And so our first kind of check-in is to kind of look at the differences. Don't worry if you are currently taking financial accounting. You'll be able to do this as we go along. So you are being introduced to the ideas about financial accounting at the same time as managerial accounting. But managerial accounting is to help managers, those inside our organization, get the information they need to make decisions. So instead of like it is in financial accounting, which the focus, according to U.S. FASB, or the gap that's established by the Financial Accounting Standards Board, their primary focus is investors outside the organization. So managerial accounting has a different focus, and that is going to govern everything we do in this class. There are no set rules. We don't have a corresponding gap or generally accepted accounting principles for managerial accounting. So the things we learn this term will be more kind of what is generally done, not what is established by an official rule setting body. So there is nobody to, you might say, appeal to as far as how things should be exactly done. So there's a lot of flexibility in how things are done, and each organization may have a little different take on how they want to see things, how it should be presented. And you just need to be aware that that is the case. And that's legitimate. That's not someone trying to be dishonest or fraudulent. They literally are looking for different things in different organizations. Spend a lot of time looking towards the future. And not that we don't look at the past, but in managerial accounting, but we spend a lot of time looking for the future, and we use the past to try to predict the future. That's an awful lot of what we're going to try to do, is see how what we can identify from our past that will help us inform the future. Financial accounting really is historical information presented as clearly and as completely as possible, so that the investor can make the predictions. In managerial accounting, we're going to go ahead and try to do that. Some of those predictions, some of that looking to the future, are the accounting itself. A lot more detail, typically in managerial accounting. We're going to break things down into its pieces. We're going to do accounting for a week and for a day sometimes. We're going to look at it by product or by division. U.S. GAAP specifically says that kind of information should be consolidated, put together, and so we're looking at the overall health of a company, not individual products. So managerial accounting much more able to break things down, look at things in a different way. And managerial accounting encompasses a whole lot of non-financial measures. Not only how profitable we are, but also how we do in some other measures of success. Financial accounting dabbles in that, but doesn't have a lot of non-financial measures, although that is changing. But officially, that in the U.S. GAAP is still primarily financial information, not non-financial information. All right, why do managers want accounting information? What is it that they are going to use it for? First of all, as we said earlier, we're trying to plan. Managers are trying to get everybody on board working in the same direction to accomplish company's goals. And the only way you're going to reach those goals is if you have the resources necessary to reach them. So that's what a manager is trying to do. Establish that vision or those goals and marshal the resources, get the things that are needed to make that happen. The people, the products, the machinery, all of that, the money that is needed to make things successfully reach those goals. So that's the planning. And then the idea of controlling, seeing if we did reach those goals. Compare our goals to what actually happened and see where we were successful, where we need to still work, where we need to improve. Sorry about that, and so forth. So that is basically what they're hoping and looking for. And I'll tell you that, unfortunately, in many organizations, the accounting information is not sufficient to reach these two objectives. And so there's a lot of room for improvement in getting the information on time in the format that would help that managers make these decisions. So a little bit about who you might encounter if you were to work in corporate or managerial accounting. So typically a large organization is going to have a chief financial officer who oversees the entire financial reporting function. So they look at both the financial and the managerial. They oversee all of that. The controller is usually one step below the chief financial officer. Typically, they report to the chief financial officer, and depending on the size of the company, there may be multiple controllers. Sometimes they break that down. The controller is just for a product or just for a plant. But that controller is much more hands-on. They have not as much visibility. Chief financial officer is going to communicate with outside parties. If you're publicly traded, they're going to one that's going to be talking to shareholders and all that type of thing. Controller is more the eyes and ears to supervise the accounting function. Make sure the financial accounting is done correctly, that the information is gathered and moved around, the bills get paid on time. All those things come under the controller. They don't pay the bills, but they're going to make sure that those people who do that are properly supervised and have the resources they need. Treasurer also reports to the chief financial officer, and a lot of companies don't have treasurers. This is for only the very largest of companies. They have a treasurer because their focus is very narrow. It's just on how much money, excess cash they have, whether you have enough cash, whether and if you need to borrow or if you need to pay off loans, that sort of thing. So they're constantly looking at cash flow and negotiating with the banks. If you don't have a treasurer, the controller is going to take care of that, or it might bump up to the chief financial officer. A financial accountant is a whole range of people that make sure that we gather all the information. So that's a very broad concept and multiple levels of responsibility. Who would be a financial accounting to make sure that we prepare the income statement, balance sheets, finance, all the other statements on time, okay, with the information correctly done, and so forth. Managerial accountant is going to support the managerial decisions. They're going to be building budgets. They're going to be working on decision making internal to the company, gathering. Often you'll see that the term is a little misleading because that in real life they're often called financial analysts because they're constantly looking at the data in different ways. A financial accountant's more worried about whether it fits the rules. The managerial accountant is trying to slice and dice the data differently depending on what decision is being made. An internal auditor, really important, usually comes into play in little bigger organizations. They are checking everybody else's work internally. They will have a role in making sure that the numbers are correct, but they are even more so worried about whether or not we followed proper procedures, whether we, if this is how something should be accounted for, or how it should be done, how the bill should be paid, is that what's happening? Is it the most efficient way? Is it effectively accomplishing what we need to? Are we breaking any laws? Are we, going through and getting the proper authorizations? Are we following the internal controls that we have established to make sure that someone can't steal from us? All that sort of thing is internal auditor, and they will actually do formal write-ups of audits of the various parts of the organization. And then finally, if you have enough complicating factors, you will have a separate individual who's just worried about the tax implications of the decisions. How do we report this on what's happened on our tax return? Where are the rules different for taxes versus financial accounting, managerial accounting, that sort of thing? So they are very busy, a shorter period of time, but they are looking at the tax issues year round, even not just when the tax return is filed. And again, if you aren't a larger organization, this could all of these could be done by a single person. It's just a lot of work, and especially in a small business, you may not be able to have a separate for each of these roles. So, a little bit about accounting ethics. Again, because there's not a set rules, we fall back on the idea that accountants in this role must follow a standard of ethical conduct. Otherwise, they could do things really however they want. Here's the problem. And so we need to create a situation where they use professional judgment that is competent, meaning they have the training and the background they need to do it. They don't jump in and give recommendations on things they don't know what's happening. They need to admit when they need to learn more. They need to keep learning, meaning that we want them to always be doing continuing education in accounting. They need to keep things confidential. This information in managerial accounting special is not for the outside parties. It is for internal, so we don't go blabbing about what we found to our friends at on the weekend at the beach. We keep things confidential. Now, that can be a challenge if we find somebody has done something that is not according to the best judgment. Or that it could affect financial accounting, because this makes it sound like there's two completely separate. But the financial accounting pulls information from the same system as the managerial. So if there's a problem with the system, it's not only going to affect managerial accounting decisions, it's also going to affect financial accounting decisions and what's reported on the financial statements, which does have rules, does have enforcement for the SEC. And so there may be times when you may have to decide whether the information should go to outside parties so that they are not misled based on what is being reported. So that's a difficult thing. But in general, the information about our business should be kept confidential. We need to be of utmost integrity, meaning we can be trusted. County information is only good, it only has benefit if it can be trusted, because that's what it's for. It's for making decisions, and you can't trust it, you can't use it to make decisions. And so we have to be completely honest, even if it's hard, even if it doesn't get us ahead. We need to do what is that can be trusted. And that's really what credibility as well is about. So integrity is kind of our own personal approach to it, and credibility is how we come across and having the correct information, making sure we did our what we call due diligence. We really dug in and found all the details. That's what makes us credible. So if we have a conflict, meaning we can't decide, we were asked to do something that we shouldn't do, we should go to our superiors. If the superior is the one that's asking us to do something we're unsure about, or we think is will not fit within our standards of conduct, then we should go to the next level, and we may have to go all the way to the top. We may have to go to the board of directors, which should be independent. That should be our place of going. We can consult attorneys. We can consult, Institute of Management Accountants provides a place you can call in and actually talk through various ethical decisions. So ethics is so important for getting the correct information and good decisions by organizations. I can't emphasize that enough.